On Tuesday, American federal debt crossed $40 trillion. Same session, the 30-year Treasury yield touched 5.33%, the highest since 2007. Wednesday, the Treasury said it would double its long-end buybacks. Yields fell hard for one session, and by Friday, the whole move was gone. The S&P fell 1.4%, which reads like nothing happened. Underneath it, a 45-name basket of everything you need to physically build a data center fell 8.5%, while gold, silver, and Bitcoin all ripped. That's not a growth scare, and it's not a Fed week. It's a market sorting assets by one question. Does this need financing, or can it not be printed? 2 calls, 2 hits, and then something I missed entirely. I said 60-40 that at least 2 of Home Depot, Lowe's, Target, and Walmart would close lower on their report day. Exactly 2 did, and my falsifier needed 3 higher. I also gave 55-45 that Walmart clears its revenue number and still doesn't close green. It cleared at $187.9 billion and closed down 9. Here's what I didn't do last week. I built the whole thesis on margins and spent 0 words on the long end of the bond market, and the long end set every price this week. That's why this episode looks nothing like the last one. Healthcare rose 4.33%. Technology fell 3.53%, and utilities were nearly as bad as tech. That last pairing is the tell, but they didn't break together. Tech went on Tuesday's yield spike. Utilities were down barely 1% through Thursday, and then lost 2.25% on Friday, a day the index rose. The growth trade broke on the spike. The bond proxy broke after the rescue failed. The VIX closed at 15.13. The options market never thought this was a crisis, and it wasn't one. 199 S&P names rose and 302 fell, yet the median member fell 1.05% against the index at 1.43. The typical stock beat the index in a down week. The trend underneath still deteriorated. The share of the index above its 50-day average dropped from 69.5% to 57.9% in 5 sessions. Concentrated damage plus a weakening trend is what a rotation looks like while it's still running. Moderna rose 177% in one session Wednesday, then gave back 23.5% Thursday. Merck moved 12.6% the same day on the same trial. They split that asset 50-50, and in dollars the market handed Moderna $44.5 billion and Merck $42 billion. Near identical money, 14 times the percentage, and that's the size of the denominator, not the drug. Walmart beat on revenue and earnings, raised the full year, and fell 10%, because U.S. comparable sales came in at 2.6 against the street at 3.8, its slowest U.S. comp in 6 years. And the build-out complex came apart. 39 of my 45 names lost 5% or more. Here's where I part company with how this week is being read. The story going around is that AI capex is cracking. I don't think Tuesday was about AI demand at all, and I have 2 measures. First, of the 44 names in that basket that fell, the median one did 72% of its entire weekly damage in a single session. Tuesday, no capex cut, no canceled lease, no downgrade that day, just a 19-year high in the 30-year yield. Second, and this is the one that matters, high-yield credit spreads widened 8 basis points to 275 by Thursday, which is the last print published. That's the whole move. Equity holders derated AI infrastructure by 8.5%, and the people who lent these companies the money repriced a rounding error. One of those 2 groups is wrong, and on this evidence, the derating looks overdone. Want this every Saturday? Subscribe. I've built deep dives on the contractors, the grid queue, and the cooling inside that basket. 3 commodity complexes ripped this week, and in all 3, the underlying barely moved. Start with copper, where the supply news was real. A fatal accident halted Las Bambas in Peru, roughly 2% of world mine supply, and it only began restarting Friday. Copper fell that day anyway. On the week, the copper fund finished down 0.05%, while the miners rose 10.4% and Freeport rose 15.3%, its best week since September 2024. Uranium spot sat flat near 87.55, while Cameco jumped 7.2% Friday alone on a Westinghouse listing it filed for 3 weeks ago, not on uranium. Rare earths did the same. When the equity moves and the underlying doesn't, the flow is financial. That works until somebody asks the commodity to confirm it. Here's the connection nobody made this week. and every piece of it is checkable. In February, the Supreme Court struck down the emergency tariffs 6-3, and up to $175 billion became refundable to importers. Set that against the retail quarter you just watched. Walmart booked about $2.9 billion of those refunds and said they were 750 basis points of its adjusted operating income growth. Target booked $994 million, $1.65 of a 411 print. So strip it out and the number is $246. Then Tuesday, when the debt crossed 40 trillion months earlier than forecast, the Washington Post named the lost revenue from those same tariffs as part of the reason. One pot of money, a one-time gain on 5 retail income statements, and a permanent hole in the federal one. Walmart's own next quarter guide, 62 to 64 cents against a street near 68, is the run rate once it stops. The growth data this week was the best in 4 years, and the market fell anyway. Composite activity surveys hit a 52-month high Friday, and the Philadelphia Fed printed 47.4 against 25 expected. Underneath that headline, new orders fell, shipments fell, both price indexes fell, and the ISM adjusted version of the same survey declined. Then Wednesday's minutes. 3 officials dissented in favor of raising rates, and the document says, quote, many participants assessed that policy tightening would likely be necessary if inflation did not decline. So the sign is flipped. September is priced roughly 60-40, hold against a hike, and nothing at all for a cut. Good news is the bearish outcome now. Friday was a broad bounce, with 330 advancers against 169, every average at least a point better than Thursday. But watch what stuck from Wednesday's intervention. The long bond fund rose 1.67% on the buyback announcement, gave back 1.17 over Thursday and Friday, and finished the week at plus 0.01. A round trip to nothing. The gold fund added another 2.3 after Wednesday. Bitcoin added about 13% more after the rates relief had already been handed back. The bond market didn't believe the rescue, and the debasement trade never needed it to. Nothing is scheduled, and I mean nothing. No OPEC Plus meeting. That's September 6th. China's PMI is next Sunday night. Not this one. No Berkshire print. No G7 rating action. One live item that matters. The 60-day window on the U.S.-Iran talks expired Monday with no deal, and Thursday the Treasury Secretary promised, quote, the toughest sanctions in history. He also gave it a time, 2 p.m. Monday at Treasury. So the weekend risk isn't the announcement. It's that the blockade is already running while the sanctions aren't, in a Brent near 94. That gap comes Monday afternoon, not Monday morning. Wednesday is the whole quarter. Core PCE lands at 8:30, and it's Wednesday this month, not Friday. Consensus is 0.2. NVIDIA reports that afternoon, Street at $91.85 billion against a company guide near 91. Friday at 10, Kevin Warsh gives his first Jackson Hole keynote as chair. The call. Base case about 60-40. NVIDIA beats that number, and the semis fund still doesn't close above 550.42, last Friday's close, in the 5 sessions after the print. If Tuesday was a duration event, a good print can't fix it because what broke wasn't demand. The risk nobody's priced has a date on it. Treasury sells $183 billion of notes Tuesday through Thursday, and the bigger buybacks don't start until September 9th. Treasury doubled the long end size, $2 billion to at least $4 billion, but the version running right now is still the old one. The supply arrives first. Push the 30-year back above 5.33, and every levered balance sheet in that complex gets repriced again, and this time credit has to answer. I'll put that at about 55.45. The 30-year trades back above 5.33 before the September meeting. 3 more levels. 7641 is Thursday's low close, and 2 closes under it mean the unwind has left the AI complex for the index. 7786 was last Friday's close. Taking it back says Tuesday was 1 day of positioning. And 275 on high yield is the referee. Spreads past 300 inside 2 weeks, and I was wrong, because credit wasn't disagreeing with equities, it was just late. I'll grade every one of those here next Saturday, starting with whatever I got wrong. I'm Big Z. Follow me. See you in the next deep dive.